You know that feeling when you think you understand how the world works, when you believe that the people running billion-dollar companies and making decisions that affect millions of lives are somehow smarter, more careful, more honest than the rest of us. And then one day, you discover that everything you believed was built on a foundation of lies so elaborate, so audacious, so breathtakingly reckless that it makes you question whether anything in the financial system can be trusted at all. This is the story of Lee Farkas, a man from Ocala, Florida, who didn't just bend the rules or cut a few corners. He orchestrated one of the most devastating frauds in American history, a scheme so massive it helped trigger the failure of a major bank, contributed to one of the largest financial crises since the Great Depression, and cost taxpayers nearly $3 billion. And the craziest part, the part that will make your blood boil, is how simple his con actually was, how many people were in on it, and how close he came to getting away with it completely. We're going back to the early 2000s, to a time when the housing market was exploding, when everyone from Wall Street executives to your next-door neighbor was convinced that real estate prices would climb forever, when mortgage companies were handing out loans like candy on Halloween. And in the middle of this frenzy, in a modest city in central Florida, a mortgage company called Taylor Bean and Whitaker was growing at an absolutely insane rate, becoming one of the largest private mortgage lenders in the entire United States. And at the helm of this company was Lee Farkas, the chairman, a man who projected confidence and success, who drove expensive cars and lived in a beautiful home, and seemed to embody the American dream of building something from nothing. But here's what nobody knew, what the thousands of employees didn't know, what the investors didn't know, what even most of the executives didn't know. Taylor Bean and Whitaker was completely, utterly, catastrophically broke. The company was hemorrhaging money, drowning in bad loans and terrible investments. And instead of admitting failure, instead of facing reality and shutting down or restructuring, Lee Farkas made a choice that would eventually destroy lives, end careers, and contribute to a financial catastrophe that affected every single person in America. He decided to fake it, to create an illusion so convincing that it would fool not just casual observers, but sophisticated financial institutions, federal regulators, and some of the smartest accountants and auditors in the business. And the way he did it, the mechanics of his fraud, they're both shockingly simple and mind-bendingly complex at the same time. Let me explain how this worked, because once you understand the basic con, you'll realize just how vulnerable our entire financial system really is. Mortgage companies like Taylor Bean don't usually keep the loans they originate. Instead, they bundle them up and sell them to bigger banks and financial institutions like Freddie Mac and Fannie Mae, those government-sponsored enterprises you've probably heard about. And this system works beautifully when everyone plays by the rules, because it allows mortgage companies to free up cash, make new loans, and keep the housing market humming along. But there's a critical moment in this process, a brief window between when a mortgage company originates a loan and when they sell it to the bigger institution. And during that window, the mortgage company needs to have enough cash on hand to operate, to pay employees, to fund new loans, to keep the lights on, and this is where Lee Farkas saw his opportunity. Taylor Bean had a relationship with a bank called Colonial Bank, one of the largest regional banks in the country, headquartered in Alabama, with billions in assets and a reputation that had been built over decades. And Colonial Bank would provide what's called warehouse lending to Taylor Bean, basically giving them short-term credit secured by the mortgages they were about to sell. Think of it like a bridge loan. And this arrangement was perfectly normal, perfectly legal, and worked great, as long as everyone was honest about what mortgages actually existed. But Lee Farkas wasn't honest, not even close. What he did, and this is where it gets absolutely wild, was create fake mortgages out of thin air, completely fictional loans that never existed, with fake borrowers who never bought homes. And then he would use these phantom mortgages as collateral to get real money from Colonial Bank. And once he had that real money, he would use it to cover up other holes in Taylor Bean's finances, to make payroll, to fund operations, to maintain the illusion that everything was fine. And then when it came time to sell these mortgages to Freddie Mac or other institutions, he would sell the same real mortgages multiple times, taking one legitimate mortgage and selling it to 2 or 3 or even 4 different buyers, collecting payment over and over again for the same asset, which is like selling your car to 5 different people, and somehow convincing each of them that they're the only owner. Now you might be thinking, how is that even possible? How could sophisticated financial institutions not notice that they're buying the same mortgage multiple times? And that's a really good question, one that should make you very concerned about how our financial system actually works. The answer is that the mortgage industry in the 2000s was moving so fast, processing so many loans, dealing with so much volume, that the normal checks and balances that should have caught this fraud were either overwhelmed or deliberately circumvented. And Farkas had help, crucial help from people inside Colonial Bank itself. Because you can't pull off a fraud this big alone. You need co-conspirators. You need people willing to look the other way, to falsify documents, to lie to regulators. And Farkas found those people. One of his key partners in crime was a woman named Catherine Kissick. She was a senior vice president at Colonial Bank, someone with significant authority and access to the bank's systems, and she wasn't some low-level employee who got pressured into going along with the scheme. She was right there in the thick of it, actively participating in the fraud, helping to move money around, helping to create false records, helping to deceive auditors and regulators. And the question that haunts this entire story is, why? Why would someone with a good career, with a stable position at a major bank, risk everything to help a mortgage company commit fraud? The answer is probably a mix of things. Maybe she thought they'd never get caught. Maybe she was getting kickbacks or benefits we don't know about. Maybe she genuinely believed that the fraud was temporary, that they were just smoothing out some rough patches and everything would eventually be legitimate again. But whatever her reasoning, her participation was absolutely essential to making the scheme work, because without someone inside Colonial Bank, Farkas couldn't have manipulated the records and systems the way he did. And the scheme they created together, it had a name. They called it Plan B, which sounds almost innocent, like a backup plan for a corporate presentation. But Plan B was actually a systematic method for stealing hundreds of millions of dollars. And here's how it worked in practice. Taylor Bean would submit mortgage loans to Colonial Bank as collateral for funding. Colonial Bank would wire money to Taylor Bean based on these mortgages. And then Taylor Bean was supposed to either sell those mortgages to investors like Freddie Mac or Fannie Mae and pay back Colonial Bank, or keep the mortgages and make payments to Colonial Bank over time. Simple enough, right? But what Farkas and Kissick did was manipulate this process in multiple ways simultaneously. First, they would create entirely fake mortgage files, complete with fake borrower information, fake property appraisals, fake employment verification. Everything you'd need to make a mortgage look legitimate. And they would submit these fake mortgages to Colonial Bank as if they were real, getting real money in return for assets that didn't exist. Second, They would take real mortgages that Taylor Bean had legitimately originated and sell them to multiple buyers. So they'd sell a mortgage to Freddie Mac, collect the payment, but then not pay back Colonial Bank. And instead they'd use that same mortgage as collateral again, with Colonial Bank to get even more money, essentially doubling or tripling the value they extracted from each real mortgage. Third, and this is where it gets really intricate, they would manipulate the accounting systems at both Taylor Bean and Colonial Bank to hide these transactions, moving money between different accounts, creating false entries, backdating documents, doing whatever it took to make the books look clean when auditors came around. The scale of this operation was staggering. We're not talking about a few $1 million here and there. We're talking about a fraud that eventually totaled nearly $3 billion. That's billion with a B. And it went on for years, from around 2002 all the way until 2009, when the whole thing finally collapsed. And during those years, Lee Farkas lived an increasingly lavish lifestyle. The money flowing through Taylor Bean allowed him to maintain the appearance of success, to invest in other businesses, to present himself as a major player in the mortgage industry. And the really disturbing part is that Taylor Bean was actually winning awards during this time, getting recognition as one of the top mortgage lenders in the country, appearing on lists of the fastest-growing companies. And all of it was built on fraud. Every award, every accolade, every press release was celebrating a company that was essentially a criminal enterprise, disguised as a legitimate business. But here's where the story takes an even darker turn, because the fraud at Taylor Bean didn't just affect the company itself, or even just Colonial Bank. It spread out like a poison through the entire financial system, contaminating everything it touched. Remember, Taylor Bean was selling mortgages to Freddie Mac and Fannie Mae, those government-sponsored enterprises that are backed by taxpayer money. And when you sell fake mortgages or sell the same mortgage multiple times to these institutions, you're essentially stealing from every American taxpayer. You're taking money that's supposed to be supporting the housing market and helping people buy homes, and instead funneling it into your own pockets. And the amounts were massive. Taylor Bean sold more than $1.9 billion in fraudulent loans to Freddie Mac alone. Think about that for a second. Nearly $2 billion in fake or duplicated mortgages, all of them sitting in Freddie Mac's portfolio like ticking time bombs waiting to explode. And explode they did, because eventually, inevitably, the whole scheme started to unravel. You can only juggle fake mortgages and real money for so long before somebody notices that the numbers don't add up, that the same loan is appearing in multiple places, that borrowers who are supposed to exist can't be found, that properties that are supposed to be mortgaged don't have the right paperwork. And as the housing market started to turn in 2007 and 2008, as foreclosures started piling up, and people started looking more carefully at mortgage portfolios, the cracks in Taylor Bean's facade began to show. Colonial Bank started having its own problems. The bank had invested heavily in mortgages and mortgage-backed securities, and as the housing crisis deepened, those investments started going bad. And when auditors and regulators started digging into Colonial Bank's books, they started finding irregularities, transactions that didn't make sense, money that couldn't be accounted for, mortgages that appeared to be duplicated or falsified, and the more they looked, the worse it got. Now here's something that should absolutely infuriate you. Throughout this entire period, from 2002 to 2009, Colonial Bank was being regularly audited. They had external auditors coming in. They had internal compliance officers. They had federal regulators who were supposed to be monitoring the bank's activities. And somehow, despite all of these layers of oversight, despite all of these supposed safeguards, The fraud continued undetected for 7 years. 7 years of systematic stealing, 7 years of fake mortgages and duplicated loans and falsified records, and nobody caught it until it was too late to prevent massive damage. The question that haunts every financial crisis is always the same. Where were the regulators? Where were the auditors? Where were all the people whose job it was to catch exactly this kind of fraud? And the uncomfortable answer is that they were there. They were looking at the books. They were reviewing the transactions. But they either missed the signs, or didn't look hard enough, or were somehow convinced by the fraudsters that everything was legitimate. And this is why the Lee Farkas story isn't just about one man's greed. It's about systemic failures in how we regulate and oversee financial institutions. It's about the gaps and vulnerabilities that allow smart criminals to operate for years before getting caught. By 2008, the situation at Colonial Bank was becoming critical. The bank was losing money, its stock price was plummeting, and federal regulators were circling, asking harder questions, demanding more detailed answers, and Lee Farkas knew that time was running out. But instead of coming clean, instead of admitting the fraud and facing the consequences, he decided to double down in the most audacious way possible. He tried to get Colonial Bank included in the Troubled Asset Relief Program, TARP, that massive government bailout program that was created in response to the financial crisis. Let that sink in for a moment. The man who had been systematically defrauding Colonial Bank for years, who had helped push it to the brink of failure with his fake mortgages and duplicated loans, was now trying to get taxpayer money to bail out the very bank he had been stealing from. It's like an arsonist applying to join the fire department while the building is still burning. And the truly insane part is that he nearly succeeded. To get Colonial Bank into TARP, Farkas needed to make the bank look healthier than it actually was. He needed to show that it had sufficient assets and wasn't at immediate risk of failure. So he orchestrated what prosecutors would later call a massive scheme to deceive federal regulators and TARP administrators. He arranged for Taylor Bean to make what looked like large deposits into Colonial Bank, moving money around to create the illusion of financial strength. He falsified documents to hide the extent of the bank's problems. He coordinated with his co-conspirators to present a picture of stability that was completely divorced from reality. And for a brief moment, it looked like it might work. Colonial Bank was initially approved for TARP funds. The government was preparing to inject hundreds of millions of taxpayer dollars into a bank that was riddled with fraud. And if that had happened, if those TARP funds had actually been distributed, Lee Farkas would have essentially stolen from the American people. Twice. Once through the fraudulent mortgages sold to Freddie Mac, and again through the TARP bailout. But at the last possible moment, literally days before the TARP funds were supposed to be distributed, federal investigators discovered the fraud. They found evidence of the fake mortgages, the duplicated loans, the falsified records. Everything came tumbling out all at once, and Colonial Bank's application for TARP funds was immediately rejected. And more than that, federal authorities moved in with search warrants and subpoenas. They raided Taylor Bean's offices. They seized Colonial Bank's records. They started interviewing employees and building a criminal case. And Lee Farkas, who had been living large for years, who had been flying high as the chairman of one of America's biggest mortgage lenders, suddenly found himself staring down the barrel of a federal investigation that would eventually put him behind bars for decades. Colonial Bank didn't survive. In August 2009, federal regulators seized the bank and shut it down. It was one of the largest bank failures in American history, and the Federal Deposit Insurance Corporation, the FDIC, had to step in to protect depositors, costing the Deposit Insurance Fund nearly $3 billion. And that money, that $3 billion, it came from the FDIC's reserves, which are funded by premiums paid by all banks, which means that every bank in America had to pay more in insurance premiums because of what Lee Farkas did. And those costs get passed on to consumers through higher fees and lower interest rates on savings accounts. So even if you never had an account at Colonial Bank, even if you never got a mortgage from Taylor Bean, you were affected by this fraud. We all were, because when a bank fails on this scale, the ripples spread out to touch everyone in the financial system. And what about Taylor Bean and Whitaker, the company that Lee Farkas had built into one of the largest mortgage lenders in the country? It collapsed almost overnight, in August 2009. The same month Colonial Bank was seized. Taylor Bean filed for bankruptcy. Thousands of employees lost their jobs, many of them completely innocent people who had no idea that the company they worked for was engaged in massive fraud. They showed up to work one day and were told to pack their things and leave. Their careers disrupted, their livelihoods destroyed, all because the man at the top had decided that stealing was easier than running a legitimate business, and the borrowers who had mortgages with Taylor Bean, many of them found themselves in limbo, unsure who owned their loans, who they should be making payments to, whether their mortgage documents were even valid. It was chaos, pure chaos, and it affected real people, families trying to keep their homes, people who had done everything right but got caught up in someone else's criminal scheme. The federal investigation into Lee Farkas and his co-conspirators moved fast. Prosecutors from the Department of Justice, working with the FBI and other federal agencies, built an overwhelming case. They had documents, they had email records, they had testimony from cooperating witnesses, they had forensic accounting that laid out the fraud in excruciating detail, and one by one, Farkas's co-conspirators started to fold. Catherine Kissick, the Colonial Bank senior vice president, who had been so crucial to the scheme, she pleaded guilty and agreed to cooperate with prosecutors. She was eventually sentenced to 8 years in federal prison. 8 years for helping to orchestrate a fraud that cost billions of dollars and contributed to a major bank failure. And you might think that's a stiff sentence, and in some ways it is. But when you consider the magnitude of what she did, the number of lives affected, the damage to the financial system, 8 years seems almost inadequate. But that's how our justice system works. Cooperate with prosecutors, help them build cases against bigger fish, and you get a reduced sentence. Other co-conspirators also pleaded guilty: executives at Taylor Bean, employees at Colonial Bank, people who had gone along with the fraud, either because they were getting paid off, or because they feared losing their jobs, or because they genuinely believed that they were just following orders, and all of them faced prison time. All of them had their lives and careers destroyed. And while there's certainly a temptation to feel sorry for them, to see them as victims of Lee Farkas's manipulation, the reality is that they were adults who made choices, who knew or should have known that what they were doing was wrong, and they did it anyway. And those choices had consequences not just for them, but for thousands of innocent people. But Lee Farkas himself, he didn't cooperate, he didn't plead guilty, he fought the charges, maintaining his innocence even as the evidence against him piled up to the ceiling. And in April 2011, his case went to trial in federal court in Virginia. And the trial was absolutely devastating for the defense. Prosecutor after prosecutor laid out the evidence, document after document, witness after witness, all of it pointing to the same conclusion, that Lee Farkas had orchestrated and directed a massive fraud that had lasted for years and had cost billions of dollars. They showed how he had personally directed the creation of fake mortgages, how he had personally authorized the sale of duplicated loans, how he had personally been involved in trying to get TARP funds through deception. They showed emails where he discussed the fraud, phone records where he coordinated with co-conspirators, financial records that traced the flow of money through the scheme. It was an absolutely airtight case, the kind of case that makes defense attorneys want to quit their jobs and become park rangers instead. And the jury, 12 ordinary citizens who had been called to serve, who had to sit through weeks of complex financial testimony and mountains of documents, they didn't take long to reach a verdict. They found Lee Farkas guilty on all 14 counts, guilty of conspiracy to commit bank and wire fraud, guilty of bank fraud, guilty of wire fraud, guilty of securities fraud, guilty on every single charge. And when that verdict was read in the courtroom, when the jury foreman stood up and said guilty 14 times in a row, it was one of those rare moments of clarity in our justice system, a moment where right and wrong weren't murky or ambiguous, where a criminal was being held accountable for his crimes in the most clear and unambiguous way possible. But the story doesn't end with the verdict, because the really important moment, the moment that would determine what kind of message this case would send, came a few months later at sentencing. Federal judges have a lot of discretion in white-collar crime cases. They can be lenient, taking into account factors like a defendant's age, health, family circumstances, potential for rehabilitation, or they can be harsh, throwing the book at defendants to send a message that financial fraud won't be tolerated. And Lee Farkas's sentencing hearing was one of the most anticipated in years, because this wasn't just about punishing one man. It was about making a statement about how seriously we take financial fraud, especially fraud that contributed to a crisis that devastated the entire economy. The prosecutor argued for the maximum sentence. They pointed out the scope of the fraud, the billions of dollars in losses, the thousands of people affected, the damage to the financial system. They argued that Farkas had shown no remorse, that he had fought the charges instead of accepting responsibility, that he deserved the harshest possible punishment, and the defense argued for leniency. They talked about Farkas's age, his health problems, his lack of a prior criminal record. They tried to paint him as someone who had made mistakes, but wasn't a hardened criminal. They asked the judge for mercy, for a sentence that would still punish, but wouldn't amount to a life sentence. And the judge, the Honorable Leonie Brinkema, a federal district judge with a reputation for being tough but fair, she listened to both sides. She reviewed the evidence. She considered the arguments. And then she delivered a sentence that shocked many observers. 30 years in federal prison. 30 years. One of the longest sentences ever handed down in a white-collar fraud case. Longer than sentences given to many violent criminals. Longer than what many people thought was even possible for financial crimes. And Judge Brinkema didn't mince words when she explained her reasoning. She said that the fraud was one of the most egregious she had ever seen, that it had caused immense harm, that it had contributed to a financial crisis that affected every American, and that Lee Farkas deserved to spend what would likely be the rest of his life behind bars. 30 years. Think about that. If you're 30 years old when you're sentenced, you'll be 60 when you get out. If you're 50, you'll be 80. For Lee Farkas, who was 58 at the time of sentencing, a 30-year sentence was effectively a life sentence. He would be 88 years old before he was eligible for release. And while federal prisoners can get some time reduced for good behavior, even with the maximum reduction, he would still be in his early 80s before seeing freedom again. And the judge made it clear that this wasn't just about punishing Farkas. It was about sending a message to every other would-be financial fraudster out there. That if you steal on this scale, if you damage the financial system, if you cost taxpayers billions of dollars, You will go to prison for a very, very long time. And that sentence, that 30-year sentence, it was controversial. There were people who thought it was appropriate, who said that Farkas deserved every day of it, who pointed out that the harm he caused was immeasurable, and that a long prison sentence was the only way to deliver justice. But there were also people who thought it was excessive, who argued that white-collar criminals, even ones who steal billions, shouldn't get longer sentences than murderers and rapists, who said that 30 years was too harsh, that it was driven by public anger about the financial crisis rather than by a rational assessment of Farkas's crimes. And both sides had valid points, because the question of how to punish financial crime is genuinely difficult. How do you measure the harm caused by a fraud that affects thousands or millions of people indirectly? How do you balance the desire for retribution with the principles of proportionality and rehabilitation? These aren't easy questions, and reasonable people can disagree about the answers. But what's not debatable is the harm that Lee Farkas caused, the $3 billion in losses to the FDIC. That money came from somewhere. It came from the insurance fund that protects bank depositors, which means it came from premiums paid by banks, which ultimately came from consumers like you and me. The $1.9 billion in fraudulent mortgages sold to Freddie Mac. That came from taxpayers, because Freddie Mac is backed by the federal government, which means that when those mortgages went bad, when those losses had to be absorbed, it was American taxpayers who paid the bill, and the thousands of employees at Taylor Bean and Colonial Bank who lost their jobs, who had their careers derailed, who had to start over from scratch, they paid a price too. And the families who had mortgages with Taylor Bean and suddenly didn't know who owned their loans or where to send their payments, they suffered. And the communities where Colonial Bank had branches, where those branches closed and jobs were lost and economic activity dried up, they felt the impact. The ripple effects of Lee Farkas's fraud spread out in ways that are almost impossible to fully quantify. And this is why his story matters, why it's not just another boring financial crime case that only lawyers and accountants care about, because it illustrates something fundamental about how our financial system works and how vulnerable it is to people who are willing to lie and cheat and steal. The mortgage industry in the 2000s was moving so fast, processing so many loans, that the normal safeguards broke down. Banks were lending to people who couldn't afford homes. Mortgage companies were originating loans without properly verifying information. Wall Street was bundling these mortgages into complex securities and selling them to investors around the world. And in the middle of all this frenzied activity, criminals like Lee Farkas found opportunities to exploit the chaos, to create fake loans, to sell real loans multiple times, to steal on a scale that would have been impossible in a slower, more carefully regulated system. And the really terrifying thing is that Lee Farkas wasn't a genius. He wasn't some criminal mastermind with an IQ of 200 and a background in advanced mathematics. He was just a mortgage company executive who figured out that if he created some fake documents and got a few people at Colonial Bank to help him, he could steal hundreds of millions of dollars. The fraud itself wasn't particularly sophisticated. It didn't require hacking into computer systems or breaking encryption or anything like that. It just required a willingness to lie, to create false records, to deceive auditors and regulators. And the fact that someone with Farkas's relatively modest criminal capabilities could pull off a fraud this big for this long should scare the hell out of all of us. Because if he could do it, how many others are doing it right now? How many other financial institutions have criminals in positions of authority who are exploiting gaps in oversight and stealing money that will eventually cost taxpayers billions? The financial crisis of 2008 and 2009, the one that led to millions of foreclosures, millions of jobs lost, trillions of dollars in wealth destroyed. It had many causes. It wasn't any one person's fault. But Lee Farkas and Taylor Bean and Whitaker were part of it. They contributed to it. They helped create the toxic environment where fraud was possible, where bad mortgages were being originated and sold and bundled into securities that brought down major financial institutions. And while Farkas certainly didn't cause the entire crisis by himself, his actions made it worse. The failure of Colonial Bank, one of the 50 largest banks in the country at the time, that sent shockwaves through the financial system, that created more fear and uncertainty, at a time when fear and uncertainty were already threatening to bring down the entire economy. Lee Farkas went to federal prison in 2011, and for years he just kind of disappeared from public view. He was inmate number 03751-018 at the Federal Correctional Institution in Edgefield, South Carolina, a medium-security prison about 100 miles from Columbia. And life in federal prison, even medium-security federal prison, it's not pleasant. These aren't country club prisons where white-collar criminals play tennis and take business classes. Federal inmates work prison jobs. They live in cells or dormitories with other inmates. They eat in cafeterias. They have limited contact with the outside world. And for someone like Farkas, who had been living in a nice house in Ocala, driving expensive cars, running a major company, the adjustment must have been brutal, going from the top of the world to a prison cell, from being a respected business leader to being inmate 03751-018. That's a fall that would break most people. But here's where the story takes another turn, one that has made a lot of people very angry. In July 2023, after serving just 12 years of his 30-year sentence, Lee Farkas was released from federal prison. 12 years, not 30, not even close to 30. And the news of his release infuriated many people who had followed the case, who remembered the devastation caused by his fraud, who thought that 30 years was appropriate, and that he should serve every single day of it. So what happened? How does someone with a 30-year sentence get out after 12 years? And the answer is complicated and involves several different factors. First, federal prisoners can earn what's called good time credit, basically a reduction in their sentence for good behavior. While incarcerated, under federal law, prisoners can earn up to 54 days per year off their sentence if they follow the rules, don't get in trouble, participate in programs, basically if they're model prisoners. And this is automatic. It's not something judges can prevent. It's built into the federal sentencing system. So over 12 years, that good time credit can add up to more than a year of reduction. Second, there's a program called the First Step Act, which was passed by Congress in 2018 as part of criminal justice reform efforts. And one provision of the First Step Act allows elderly and sick prisoners to be released early if they meet certain criteria. Essentially, if keeping them in prison serves no real purpose, because they're not a threat to society anymore. And Farkas's attorneys apparently argued successfully that he qualified under this provision, that he was elderly, that he had health problems, that he wasn't a danger to anyone, and that he should be released. Third, and this is the part that really makes people angry, there's something called compassionate release, which allows prisoners to be released early for extraordinary and compelling reasons. Things like terminal illness, family emergencies, circumstances that make continued incarceration unjust. And during the COVID pandemic, compassionate release became much more common because prisons were hotbeds for virus transmission, and elderly prisoners with health problems were at high risk. So federal judges across the country were granting compassionate release to prisoners who ordinarily would have served much longer sentences. And Lee Farkas apparently benefited from this. His lawyers argued that keeping him in prison during a pandemic, given his age and health issues, was essentially a death sentence, and a judge agreed and ordered his release. Now, whether you think this was appropriate or not, probably depends on your views about criminal justice more broadly. If you believe in rehabilitation, in the idea that prisoners who are no longer dangerous should be released even if they haven't served their full sentence, then maybe Farkas's early release doesn't bother you that much. He was in his early 70s when he got out. He had served 12 years. He was presumably no longer a threat to commit mortgage fraud. What purpose would be served by keeping him locked up until he was 88? But if you believe in retribution, in the idea that criminals should face consequences proportional to their crimes, in the idea that someone who stole $3 billion and contributed to a financial crisis should serve every single day of a 30-year sentence, then Farkas's release probably feels like a slap in the face to everyone who was harmed by his fraud, to the taxpayers who had to cover the losses, to the employees who lost their jobs, to the families who lost their homes. All of those people are still dealing with the consequences of what Farkas did. And he's out, free, able to live whatever time he has left outside prison walls. And the really galling thing, the thing that makes this story feel so incomplete, so unsatisfying, is that Lee Farkas never expressed genuine remorse. He fought the charges. He maintained his innocence, even in the face of overwhelming evidence. And even after his conviction, even after being sentenced to 30 years, he appealed. He argued that he had been wrongly convicted, that the prosecution had been unfair, that he didn't deserve the sentence he received. He never stood up and said, "I'm sorry. I destroyed lives. I cost taxpayers billions of dollars. I contributed to a financial crisis. I was wrong, and I accept responsibility." He never did that. And the fact that he's now out of prison after serving less than half his sentence, it feels like he got away with it, like he beat the system, like crime actually did pay, at least partially. Where is Lee Farkas now? What's he doing with his freedom? Does he sit around thinking about the people he hurt? Does he feel any guilt or shame? Or does he tell himself that he was just playing the game the way everyone else was? That he got caught and they didn't? That he was no worse than the Wall Street executives who packaged toxic mortgages into securities and got bailed out instead of going to prison? We don't really know, because Farkas has stayed out of the public eye since his release. There haven't been interviews, no public statements, no attempts to rehabilitate his reputation. He's just gone quiet, living somewhere in obscurity, presumably prohibited from working in the financial industry ever again, probably spending time with whatever family members still talk to him, trying to enjoy whatever years he has left. But his story doesn't end just because he's out of prison, because the lessons of what Lee Farkas did, they're still relevant, maybe more relevant than ever, because here we are in 2025, and the financial system still has many of the same vulnerabilities that allowed Farkas to commit his fraud. We still have complex mortgage markets where loans are originated by one company and sold to another, and bundled into securities and traded around the world. We still have situations where the people who originate loans don't bear the risk if those loans go bad. We still have regulatory gaps and oversight failures, and opportunities for criminals to exploit the system. The technology has changed. Everything's more digital now. But the basic structures and incentives are remarkably similar to what they were in the 2000s. And we still have the same fundamental problem, which is that financial fraud is really hard to detect, and even harder to prevent, because the people committing fraud are often smart, well-educated, respectable-looking individuals who know how to create convincing false documents, who know how to manipulate accounting systems, who know which loopholes to exploit. They're not breaking into banks with guns. They're sitting in offices with computers, and they can steal more in an afternoon than a bank robber could steal in a lifetime. And the chances of getting caught are actually pretty low, especially if they're careful, especially if they have co-conspirators who help them cover their tracks. The Lee Farkas case only came to light because the fraud got so big that it contributed to a bank failure. But how many smaller frauds are happening right now that will never be detected because they're not quite big enough to bring down an institution? This is the dark reality of our financial system. It runs on trust, on the assumption that most people are honest most of the time, that the documents being submitted are accurate, that the numbers on balance sheets reflect reality, that the loans being sold actually exist and haven't been sold to someone else already. And when that trust is violated, when people like Lee Farkas decide to lie and cheat and steal, the consequences ripple out in ways that affect millions of people who never did anything wrong, who never had any contact with Taylor Bean or Colonial Bank, who were just living their lives and trying to pay their bills and save for retirement and maybe buy a house, and suddenly they're caught up in a financial crisis that costs them their job or their savings or their home. And the people responsible, the Lee Farkases of the world, they might go to prison for a while, they might serve some time, but they'll never truly pay back what they stole. They'll never undo the damage they caused. They'll never restore the lost years, or the lost opportunities, or the lost sense of security that comes from believing that the system basically works. And what about the other people involved in the fraud, the co-conspirators like Catherine Kissick, who served their time and got out? Where are they now? What are they doing? Did they learn anything from the experience, or do they just see themselves as unlucky, as people who got caught doing something that lots of others were doing too? The truth is that most of them have disappeared into anonymity. They served their sentences, they got out, and they're trying to rebuild their lives away from public scrutiny. And maybe that's appropriate. Maybe people who serve their time deserve a second chance. But it's also true that they participated in a fraud that cost billions of dollars and affected millions of lives, and no amount of prison time can really balance those scales. The story of Lee Farkas and Taylor Bean and Whitaker is a story about greed, obviously, about someone who had a successful business but wanted more, who couldn't accept failure, who thought he was smart enough to cheat the system and get away with it. But it's also a story about systemic failure, about all the ways our financial regulatory system failed to catch obvious fraud for years, about auditors who didn't audit carefully enough, about regulators who didn't regulate aggressively enough, about a culture in the mortgage industry that prioritized speed and volume over accuracy and honesty. And most of all, it's a story about consequences, about how financial fraud doesn't just affect the direct victims. It spreads out like a virus, infecting the entire system, creating distrust and instability and crisis. Think about all the people whose lives were changed by what Farkas did. Start with the employees at Taylor Bean, thousands of them. People who showed up to work every day, thinking they were part of a successful company, who had no idea that their paychecks were funded by fraud, who lost their jobs overnight when the company collapsed. Secretaries and loan processors and IT workers and custodians, all of them suddenly unemployed through no fault of their own, having to explain to prospective employers why their resume shows they worked for a company that became synonymous with fraud, having to rebuild their careers from scratch. And some of them probably never fully recovered, probably took jobs that paid less, or had to move to find work, or ended up in completely different industries because the mortgage industry was tainted by association. Then think about the employees at Colonial Bank. Another few thousand people whose employer failed because of fraud they had nothing to do with. Bank tellers and branch managers and loan officers. People who had built careers at what they thought was a stable regional bank, who maybe had been with Colonial for 10 or 20 years, who had roots in their communities, who lost not just their jobs, but their sense of professional identity, and the communities where Colonial Bank had branches, small towns and mid-sized cities across the south and southeast. They lost a major employer, lost a financial institution that had been part of the community for decades, lost jobs and tax revenue and economic activity, and those losses rippled outward, affecting local businesses that depended on Colonial Bank employees as customers, affecting schools that lost funding when property values declined, affecting everything. And then there are the borrowers, the people who had mortgages with Taylor Bean, who found themselves in legal limbo when the company collapsed, who didn't know who owned their loans, who they should be making payments to, whether their mortgage documents were even valid. Imagine the stress of that. Imagine trying to keep your home, trying to do the right thing and make your payments, but not knowing where to send them, not knowing if you're going to get foreclosed on, even though you haven't missed a payment. That kind of uncertainty, it destroys people. It causes stress and anxiety and sleepless nights and fights with your spouse, and all kinds of secondary effects that never show up in any calculation of the fraud's damage. And beyond all these direct victims, there are the indirect victims, the millions of Americans who were affected by the financial crisis that Farkas helped contribute to, the people who lost their homes to foreclosure, who lost their jobs when businesses failed, who saw their retirement savings evaporate when the stock market crashed, who had to put off retirement or cancel college plans or delay medical treatment because they couldn't afford it anymore. And yes, the financial crisis had many causes. It wasn't just Lee Farkas, but he was part of it. His fraud was one of thousands of acts of fraud and recklessness and greed that collectively brought the economy to its knees. And while you can't blame him personally for the entire crisis, you also can't separate his actions from it. He was part of the problem, a significant part. The $3 billion in losses that the FDIC had to absorb when Colonial Bank failed, that came from the Deposit Insurance Fund, which is supposed to protect ordinary Americans who keep their money in banks. And when that fund takes a $3 billion hit, it has to be replenished somehow, either through higher premiums charged to banks, which get passed on to consumers through higher fees and lower interest rates, or through emergency funding from Congress, which means taxpayer money. Either way, ordinary Americans ended up paying for Lee Farkas's fraud, people who never heard of Taylor Bean or Colonial Bank, who were just trying to save money and pay their bills and live their lives. They paid for it, and most of them probably don't even know it. They don't realize that the slightly higher ATM fee or the slightly lower interest rate on their savings account is partly because the FDIC had to cover losses from a bank failure in Alabama that was caused by fraud originating from a mortgage company in Florida. This is why white-collar crime is so insidious, so dangerous, because the harm is diffuse. It's spread out across millions of people, each of whom suffers a small loss that doesn't seem like a big deal by itself. But when you add it all up, when you calculate the total damage, it's staggering. It's billions of dollars. It's countless ruined lives. It's a loss of faith in the financial system that makes people less willing to invest, less willing to start businesses, less willing to take the kinds of risks that drive economic growth. And that loss of trust, that damage to the system itself, it might be the biggest harm of all, because it persists long after the criminal is caught and sentenced. It changes how people think about banks and mortgages and finance. It makes everyone a little more cynical, a little more suspicious, a little less likely to believe that the system is fair. And the most frustrating thing about the Lee Farkas case, the thing that makes it so maddening, is that it was preventable. Every step of the way there were opportunities to catch the fraud and stop it before it got so big. Auditors should have caught it. Regulators should have caught it. Employees at Colonial Bank, who weren't part of the conspiracy, should have noticed irregularities and reported them. Investors who were buying mortgages from Taylor Bean should have done more due diligence. There were so many points where someone could have said, "Wait a minute. Something doesn't add up here. This doesn't make sense. We need to investigate." But nobody did. Or if they did, their concerns were ignored or explained away, or buried in bureaucracy. And the fraud continued for 7 years. 7 years of stealing. 7 years of creating fake mortgages and selling real mortgages multiple times. 7 years of deceiving auditors and regulators and investors. Why did it take so long? Why did it require a bank failure and a federal investigation to uncover what should have been obvious to anyone looking carefully at the numbers? The answer is complicated and involves a lot of factors. But one big reason is that in the mortgage industry in the 2000s, nobody wanted to look too carefully. The market was booming. Money was flowing. Everyone was making profits and asking hard questions, demanding detailed audits, slowing down transactions to verify information. All of that would have interfered with the profit machine. So there was institutional pressure to just keep moving, to process loans quickly, to not be the person who gums up the works by insisting on proper documentation. And in that environment, fraud flourishes. Criminals like Lee Farkas thrive because they know that nobody is really paying attention, that as long as the money keeps flowing and the numbers look good on paper, they can get away with almost anything. This is the lesson that we should have learned from the financial crisis, that when everyone has an incentive to look the other way, when the people who are supposed to be watchdogs have reasons to not bark, the system becomes vulnerable to massive fraud, and we needed to reform that system, to create better oversight, to make sure that auditors and regulators have the resources and authority and independence to actually catch fraud before it gets so big that it threatens the entire economy. But did we do that? Did we really fix the underlying problems? Or did we just punish a few criminals, let some banks fail, bail out others, and then go back to business as usual once the immediate crisis passed? The uncomfortable truth is that the financial system today isn't that different from what it was in 2008. We have more regulations. Yes, we have the Dodd-Frank Act and stress tests and higher capital requirements. But we still have a system where mortgages are originated by one company and sold to another and bundled into securities. We still have situations where the incentives are misaligned, where the people originating loans don't bear the risk. If those loans go bad, we still have complexity that makes it hard for regulators to see what's really happening. And we still have criminals who are looking for ways to exploit the system, who are studying what Lee Farkas did and thinking about how they could do it better, how they could avoid getting caught, how they could steal even more. And this brings us to a really disturbing question. What if Lee Farkas isn't an outlier? What if he's not some uniquely evil person who did something that nobody else would do? What if he's actually pretty typical of the kind of person who rises to leadership in financial institutions? Someone who's ambitious, who's willing to cut corners, who prioritizes success and money over honesty and integrity? What if the only difference between Lee Farkas and a lot of other financial executives is that he got caught? This is a cynical view, maybe too cynical, because most people in finance are honest. Most executives don't commit fraud. But it's also true that the financial industry attracts people who are comfortable with risk, who are motivated by money, who are competitive and sometimes ruthless. And in that environment, the line between aggressive business practices and fraud can get blurry. The temptation to cross that line can be strong, especially when the rewards are so high and the chances of getting caught seem so low. Lee Farkas probably didn't start out planning to commit a $3 billion fraud. He probably started with something small, maybe fudging a few numbers to make a quarter look better, maybe creating 1 or 2 fake mortgages to cover a temporary shortfall, telling himself that it was just a short-term fix, that he'd make it right later, that it wasn't really fraud because he intended to pay it back. And then when nothing bad happened, when nobody caught it, when there were no consequences, he got bolder. He did it again and again. And each time the fraud got bigger and the lies got more elaborate, until eventually he was in so deep that there was no way out, no way to come clean without destroying everything. So he just kept going, kept doubling down, kept hoping that somehow he could hold it all together long enough to find a way out. And by the time he realized that wasn't going to happen, that the whole thing was going to collapse, it was too late. He was already guilty of crimes that would send him to prison for decades. This is how financial fraud usually works. It's not a brilliant master plan executed flawlessly from the beginning. It's a series of small compromises, little deceptions that snowball into something massive. And the people committing the fraud, they rationalize it every step of the way. They tell themselves that everyone does it, that the system is rigged anyway, that they're just leveling the playing field, that they deserve the money because they work hard, that nobody's really getting hurt because it's just numbers on a computer screen. And by the time they realize that people are getting hurt, that their fraud is causing real damage to real people, they're so committed to the lie that they can't stop. They have to keep going and hope they don't get caught. But Lee Farkas did get caught. The whole scheme collapsed, and he went to prison. And for a brief moment it seemed like justice had been served, like the system had worked, like there were consequences for financial fraud. But then he got out after 12 years, less than half his sentence. And that sense of justice, that feeling that crime doesn't pay, it evaporated, replaced by cynicism and anger, and the sense that even when we catch these guys, even when we convict them and sentence them, they still somehow win. They still get to enjoy some freedom, still get to live some version of a normal life, while their victims are still dealing with the consequences of what they did. What should have happened differently? How could this story have ended better? And there are no easy answers because the criminal justice system is complicated and imperfect, and trying to balance multiple competing goals. We want to punish criminals. Yes, but we also want to rehabilitate them. We want to deter future crimes. But we also don't want to be cruel or inhumane. We want consistency in sentencing, but we also want judges to have flexibility to consider individual circumstances, and all of these goals can conflict with each other. So you end up with situations like Lee Farkas getting a 30-year sentence that everyone assumes means 30 years, but then getting out after 12 because of good time credits and compassionate release and various other factors that most people don't understand or even know exist. Maybe the answer is that we need to be more honest about sentencing. If we're going to give someone a 30-year sentence, but we know they're probably going to get out after 15 or 20 through various reductions, maybe we should just sentence them to 15 or 20 in the first place, so that when they're released, it doesn't feel like they beat the system. Or maybe we need to eliminate or severely restrict good time credits and compassionate release for financial crimes. Make it clear that if you steal billions of dollars, You're going to serve every single day of your sentence, regardless of your age or health. Or maybe we need to rethink whether prison is even the right punishment for white-collar criminals. Maybe there are better ways to hold them accountable, like lifetime restitution requirements, where they have to keep paying back what they stole for as long as they live, or lifetime bans from the financial industry, or public shaming campaigns that make it impossible for them to ever rehabilitate their reputations. These are hard questions, and I don't pretend to have all the answers. But what I do know is that the current system doesn't feel like it's working. It doesn't feel like justice is being served when someone like Lee Farkas can steal $3 billion, get caught, get sentenced to 30 years, serve 12, and then walk free while his victims are still suffering the consequences of his crimes. That doesn't feel right. That doesn't feel like accountability. That feels like he got away with it, at least partially. And if criminals can look at his case and think, yeah, I might go to prison, but I'll only serve a fraction of my sentence, and then I'll get out and still have some years left to enjoy, well, that's not much of a deterrent, is it? The Lee Farkas story should terrify you, not just because of what he did, but because of what it reveals about our financial system, about how vulnerable it is, about how easy it is for criminals to exploit it, about how long fraud can continue before being detected, about how inadequate the consequences often are when criminals finally do get caught. This isn't ancient history. This happened in our lifetimes. The crisis he contributed to, many of us lived through it, felt its effects, lost jobs or homes or savings because of it, and the system that allowed it to happen. That system still exists. It's been tweaked and reformed, but it's fundamentally the same. And there are probably people right now, today, sitting in offices in nice buildings wearing expensive suits, who are committing fraud, who are lying and cheating and stealing, who are creating the conditions for the next crisis. And when that next crisis comes, when the fraud is finally exposed, and the criminals are caught and prosecuted, we'll all act shocked. We'll demand accountability. We'll say this can never happen again. And we'll put a few people in prison and pass some new regulations. And then we'll move on. And the cycle will continue. Because we haven't really fixed the underlying problems. We haven't addressed the incentive structures that make fraud profitable. We haven't created oversight systems that actually work. We haven't made the consequences severe enough to truly deter would-be criminals. We've just put some band-aids on a system that's fundamentally broken and hoped for the best. Lee Farkas is out of prison now, living somewhere in America, presumably trying to stay out of the spotlight. And the thousands of people whose lives he destroyed, they're still dealing with the consequences. Some of them probably never recovered financially, never got back to where they were before Taylor Bean collapsed, never regained the sense of security they had before learning that the mortgage company they trusted was a criminal enterprise. And there's no closure for them. No moment where they can say, okay, justice was served. We can move on now. Because how can there be closure when the person responsible served only a fraction of his sentence? When the system that allowed the fraud to happen is still largely unchanged? When there's every reason to believe that similar frauds are happening right now and will continue to happen in the future? This is the reality of white-collar crime in America. It's profitable. It's relatively low risk. The sentences, even when criminals get caught, are often reduced through various mechanisms. And the harm is so diffuse and affects so many people that it's hard to generate the kind of public outrage that might lead to real reform. When someone robs a convenience store for $500, we throw them in prison for years. When someone steals $3 billion and contributes to an economic crisis, we give them a 30-year sentence and then let them out after 12. And if you're a rational criminal trying to decide what kind of crime to commit, which one looks more attractive? The petty theft that gets you a long sentence with no possibility of reduction, or the massive financial fraud that might get you a long sentence on paper, but realistically, you'll serve less than half, while potentially hiding away millions that you can access when you get out. Because here's something we haven't talked about yet. What happened to the money? Lee Farkas stole or helped steal nearly $3 billion. So where did it go? Did investigators recover it? Did they claw back the fraudulent transactions? Did they seize assets and return money to victims? And the answer is that they recovered some of it, but nowhere near all of it. A lot of the money just disappeared, spent on operations, used to cover other losses, moved through so many accounts and transactions that it became impossible to trace. And there's always the suspicion, probably unfounded, but impossible to disprove, that some of it was hidden away, stashed in accounts that investigators never found, waiting for Farkas when he got out of prison. There's no evidence that this happened, no proof that Farkas has access to hidden money, but the fact that we can't rule it out, the fact that it's plausible, that should tell you something about how these cases work. When fraud operates on this scale, with this much complexity, with money flowing through so many different accounts and entities, it becomes almost impossible to fully account for everything. Investigators do their best. They seize what they can find. They follow the trail as far as it goes. But there are always going to be questions about money that can't be accounted for, transactions that can't be fully explained. And the criminals know this. They know that if they're smart about it, if they set things up right, they might be able to hide some of the proceeds where investigators will never find them. And even if Lee Farkas doesn't have any hidden money, even if he's genuinely broke and has nothing, he still lived large for years. He enjoyed the fruits of his fraud. He drove expensive cars and lived in a nice house and had the status and respect that comes with being the chairman of a major company. He had experiences and luxuries that his victims will never have, and you can't take those back. You can't unlive the years of luxury that were funded by fraud. So even if he ends up poor, even if he spends his remaining years in relative poverty, he still got something that his victims didn't. He still enjoyed benefits that were purchased with stolen money. And there's no way to balance those scales, no way to make it truly right. The story of Lee Farkas is ultimately a tragedy, not because of what happened to him. He's a criminal who got caught and punished, even if not as severely as some might like, but because of what happened to everyone else. The thousands of innocent people whose lives were disrupted or destroyed. The taxpayers who had to cover billions in losses, the employees who lost jobs, the borrowers who lost homes, the communities that lost a major employer and economic anchor. All of them are victims of a fraud that never should have happened, that should have been caught much earlier, that was allowed to continue for years because the systems we trust to protect us failed completely and catastrophically. And the worst part, the part that should keep you up at night, is that it's going to happen again. Maybe not in exactly the same way. Maybe not with fake mortgages and duplicated loans, but some version of it. Some financial fraud that exploits gaps in oversight, that takes advantage of complexity and speed and misaligned incentives, that continues for years before being detected, that causes billions in losses and ruins, countless lives. It's going to happen because we haven't fixed the underlying problems. We've just tried to patch the most obvious holes, while leaving the fundamental structures unchanged. And as long as those structures exist, as long as there are opportunities for smart criminals to exploit the system, there will be people who do exactly that. Lee Farkas is free now. After 12 years in federal prison, he's out, living somewhere, doing something, probably trying to avoid attention and just enjoy whatever time he has left. And maybe that's fine. Maybe he's paid his debt to society, served his time, earned a second chance. Or maybe it's an outrage, a slap in the face to everyone he harmed, a sign that our justice system is broken and that white-collar criminals can literally get away with murder. Financially speaking, both of these things can be true at the same time. The world isn't black and white. Justice isn't simple or clean or satisfying. Sometimes the bad guys go to prison, and sometimes they get out early, and sometimes the victims never get closure, and sometimes the system fails, and sometimes it works, and most of the time it's somewhere in between, messy and imperfect, and frustrating. But what we can't do, what we absolutely cannot do, is forget. We can't let this story fade into history, can't let Lee Farkas become just another name in a long list of financial criminals, can't let the lessons of Taylor Bean and Whitaker and Colonial Bank be lost. We need to remember what happened, how it happened, why it happened, who got hurt, what the consequences were. And we need to use that memory to demand better, to insist on real reform, to hold financial institutions accountable, to support regulators who are trying to prevent fraud, to vote for politicians who will strengthen oversight rather than weakening it in the name of reducing red tape, to stay vigilant and skeptical and unwilling to just trust that the people running banks and mortgage companies and financial institutions have our best interests at heart. Because here's the final truth, the one that ties this whole story together. Financial fraud is a choice. Lee Farkas chose to create fake mortgages, chose to sell real mortgages multiple times, chose to deceive auditors and regulators, chose to try to get TARP funds through fraud. He made those choices. And his co-conspirators made choices too. Catherine Kissick chose to help him, chose to manipulate Colonial Bank's systems, chose to lie and cover up. They all made choices. And those choices had consequences, terrible consequences, for thousands of innocent people. And the reason we put criminals in prison, the reason we have a justice system at all, is to hold people accountable for their choices, to make sure that when someone chooses to harm others for personal gain, there are consequences, real consequences that hurt, that serve as both punishment and deterrent. And when those consequences are insufficient, when criminals serve only a fraction of their sentences, when they get out early for good behavior, or health reasons, or because of prison overcrowding, or whatever other excuse, it undermines the entire system. It sends the message that crime does pay, at least a little bit. That if you're going to be a criminal, you should aim big because the cost-benefit analysis actually favors massive fraud over petty crime. This is what the Lee Farkas case teaches us, that our system for dealing with financial crime is broken, that the sentences are too light or too easily reduced, that the oversight is too weak, that the incentives are too misaligned, that the complexity is too great, that the consequences are too mild. And until we fix these things, until we make real structural changes that address the root causes rather than just treating the symptoms, we're going to keep seeing versions of this story play out. Different names, different companies, different details, but the same basic pattern of fraud and failure and insufficient accountability. And more innocent people are going to get hurt. More taxpayer money is going to be lost. More faith in the system is going to be eroded. And the criminals, they'll keep taking their chances because the odds are actually pretty good. Steal $1 billion, maybe you go to prison, maybe you don't. Maybe you serve 20 years, maybe you serve 10. Maybe you get out early. Maybe you've got money hidden somewhere. Maybe you don't. But either way, you've had the experience. You've lived large. You've had power and status and luxury. And that's more than most people ever get. So why not roll the dice? That's the calculation that Lee Farkas made, and thousands of people paid the price for it. And he's out now after 12 years, free to live whatever remains of his life, while his victims are still dealing with the fallout, still working jobs they might not have if Taylor Bean hadn't collapsed, still living in houses they might not be in if Colonial Bank hadn't failed, still managing finances that might look very different if $3 billion hadn't been stolen from the system. And there's no happy ending here, no moment of redemption, no satisfying conclusion where justice is clearly and completely served. There's just the messy reality of a broken system, a convicted criminal who served some time but not enough, and thousands of victims who will never be made whole, and the uncomfortable knowledge that this story, or something very much like it, is going to happen again, because we haven't learned the lessons we should have learned. We haven't made the changes we needed to make. We've just moved on, put it behind us, and hoped that next time will be different, even though we have no real reason to believe that it will be. Did you like the story? And from where are you listening? Tell us in the comments. And if you liked the story, please help us by liking and subscribing to keep our work going in unfolding the biggest financial crimes in human history. You are what makes our work count.